Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Investors pricing in a quarter-point cut from the FOMC at 2 p.m. Eastern Time. Gwinn of RBC Capital Markets writing the following. The economic backdrop continues to provide the FOMC with a window for delivering interest rate cuts. They're going to take it. Blake joins us now for more. Blake, good morning. Good to see you.
Good to see you.
The last time the Fed made a decision, you made a very important point, that the outlook hadn't changed so much, but the risks around the outlook have. What are the risks around the outlook now, and have they developed since the Fed last met?
Exactly the same as they were in September. Part of that is obviously because we're not getting the official sector data. But even if you look at what we have received, so the CPI that they decided to release, the private sector data, and I would say also the beige book that they had. The beige book really kind of characterized things as largely in the same place as they were in September. So I don't think the Fed's really gotten any information that's really going to change their outlook. I would expect Powell, any comments that he's going to make on the macroeconomic outlook, this afternoon are probably going to be largely what he made in September.
So cuts 25. Can he guide to December?
I don't think he does. And I think, if anything, the markets are going to be much more focused around some of the meta conversation about what are they looking at. I mean, if this continues for another 2 months, if this continues in the December meeting, I think what I'm most interested in are any questions around what data are you putting most importance on.
What are the metrics?
Yeah, we know their reaction function to some degree around the official sector data, and we know how they're thinking about, an unemployment rate or about NFP levels, but we don't really know how they're using the data that they do have right now. And I think it'll be interesting to hear how they're kind of thinking about things, what metrics they're looking at, and what's going to make that decision around December.
Well, isn't that a risk in itself, the fact that they don't have data and we have this data desert? How much can they lean on September going forward if you're a data-dependent Fed?
Well, it does make things interesting, and I'm a little bit torn about what the base case into December is if we don't get data. Because on the one hand, you kind of have this do no harm type of idea where I could see the hawks on the committee saying, hey, look, we cut the last 2 meetings. We did get inflation data, which shows the services side of things a little more pressure than we'd like to see. Maybe we should just play it safe and not do anything. But you could also make the case on the other side, which is that those labor market risks are still apparent. ADP is still showing this low hiring, slow firing mode. So I'm not even really sure what the base case is into December if we have no data, no new government data coming out.
Is it possible that dissent could cut both ways at this meeting?
Absolutely. I think that was true last meeting as well. I was actually curious to see if we got 2 dissents at the last meeting, because I think you have some members like, Hammack, Schmid, who have come out and now, not everybody can dissent. So we're just talking about the voting members.
No,
but Schmid could certainly dissent. And we have heard those members kind of take a harder stance on the inflation side and said, unlike Waller and I would say now Powell at this point, not so quick to kind of dismiss some of the inflation pressure we're seeing. They're not ready to write it off as only a tariff problem, something that's going to dissipate as that one-time price shock kind of moves through the system.
I believe that Hammack can dissent next year. And the mix next year maybe gets a little bit more interesting. So let's talk about that. We're going to get a change of leadership in May. How easy is it just to lead the committee and say, you know what, we're going in this direction, given the mix we might see in 26?
It really depends on the personnel. And I think this is, one conversation I've had a lot with clients who've kind of said, well, we're going to get a very dovish Fed chair from Trump, and they're going to come in and, they're going to slash rates 100 basis points
and do what they want.
Fed chair. Yeah, that's just not how things work. And I think we're kind of a product of this last 40 years where we've had very strong Fed chairs who I think have a very good give and take with the rest of the committee. They're respected by the committee. They're taking information from the committee, incorporating that into their own views. And so, the chair has spoken for the direction of policy. If we get somebody who is very outside of that consensus, who's to say the chair isn't a dissent at every meeting? I mean, it could be very interesting, but what if we have Mirren and the new chair dissenting at every meeting.
For the record, I saw this in the UK more than 10 years ago. I remember when Governor King wanted another round of QE and kept dissenting and voting for it. So we've seen that happen in the UK. Are you suggesting we might see a UK-type scenario in the United States?
It's just not what we're used to in the United States.
We're used to the Greenspans of this world.
Yeah, and I think if we're thinking about how dovish the Fed is next year, it's not just about how dovish the new chair is, it's also about how effective they're going to be at delivering on that dovishness.
Well, who's the most dovish end of this list? Would you say that's Kevin Hassett?
I would say you'd look at somebody who is closer to the administration, so a Hassett or a Warsh, but somebody...
He's a hawk.
He was. Let's be very clear. He was. Not anymore. So I think you'd look at somebody who is much closer to the administration is probably arguing for the most cuts, but also in the same respect, also maybe not being able to sway the rest of the committee.
But it'll be transparent. If it is someone like Kevin Hassett, it'll be transparent. It's not like Arthur Burns and Nixon, where the market didn't really understand how close that relationship is. It'll be very transparent to the market that, okay, this policy could be heavily influenced by Trump himself.
Well, I think it will be clear that that person could be heavily influenced, but then that's where the question of how much control over the rest of the committee they have comes in, because that's where I think somebody like a Waller, who may not be as close to the administration, who may kind of go off on their own, and he's leaning dovish now, but maybe that framework changes, he's going to be much more effective, and I think has that respect. He has a very understandable framework for where that dovishness is coming from, and so may actually deliver more cuts than somebody who you would expect to be a more dovish member.
Stay with us. More Bloomberg surveillance coming up after this. Stocks hitting fresh records ahead of a Mag 7 earnings test. Gargi Chaudhuri of BlackRock writing, investors are looking for proof that cloud growth is re-accelerating and that massive AI capex is converting into real paying workloads. Gargi joins us now for more. Gargi, good morning.
Hi, good morning.
It's good to see you. So out of the three then this week, Fed decision, trade talks, earnings, does earnings take number one spot?
Well, the volatility markets seem to think so. And if you look at what's priced in terms of moves per day, it certainly seems like the earnings are what's going to be a bigger driver. But certainly with the Fed, I think we should pay particular attention to what happens with the balance sheet. I do think that the 25 basis point rate cut is very well advertised and very well priced. But it's really about if they do something with the balance sheet runoff. And if that gets announced today, obviously we heard from Chair Powell earlier in the month, which was about in the coming months, but the market is expecting for some sort of announcement today. So that would be important. And then, of course, for the rest of the week, it's earnings, and then finally the New York Marathon.
The New York Marathon for you. Do you want to share it up front? How many marathons have you run?
Many. The number is many.
We're in the 20s now?
We're in the 20s.
Okay. And what charity are you supporting?
It's called Shoe for Africa. It's a charity for children in Kenya, and it's building a hospital.
Very cool. So if anyone wants to donate, of course, reach out directly.
Being modest. It's 26. That is insane.
26 is absolutely unreal. We're going to talk about that later. Okay. Let's focus on this market if we can. QT, what are the implications of backing off from QT?
Absolutely. So a couple of things. First, recognizing if that does happen, where do the reinvestments go? I think that's the main thing. Does it get reinvested back into bills only, or is it along all tenors of the curve? And obviously, if it is along all tenors of the curve, that's more demand coming in for treasury markets. And I do think if we look at what the long end, the very long end, 30 years or so have done over the past month, I think there is a little bit of expectation of that coming back into the market. So if we don't get anything at all, maybe at least in the very long end of the curve, we could get a little bit more of that steepening that we began to see earlier this year, and then it sort of stopped for the moment. But at the same time, we've talked about this for a while. This is a really good opportunity in the markets to clip coupon, especially if you're in that belly, maybe that 3 to 10 year part of the market. That still remains. We're still in a path for the Fed to cut now and again in December. So very clearly, that's going to be another boost to equity as well as income markets.
The Fed cutting in December, are they basically accepting that 3% as the new 2%?
I don't know that it's 3% per se. If you think about, especially with this last CPI print, what we saw was that very sharp and clear deceleration in OER, and where we saw the inflation was in much more of the temporary areas such as tariff-related goods, apparel, etc. If we continue to see that deceleration in OER, in shelter more broadly, I think you can reach a world by the end of 2026 when you're seeing sort of that 2.5% core CPI. And I think that is something that the Fed will accept and be able to, at least the Fed, the future Fed probably will be able to live with in a world where some of the inflation that is coming through is probably more transitory in nature. I think it's all about shelter and it's all about OER, and we've seen some very good numbers on that front.
We also have the trade talks happening. The possible lowering rate of the U.S. tariff level on China, is that helpful for the Federal Reserve?
I think it has to be. Again, when we talk about what is the transitory, temporary drivers of inflation, some of those, as we have seen in the core goods data over the last 3 months, are very much related to those tariff inputs. So to the extent we now can live in a world where that tariff rate is severely higher than last year, but not as high as we had expected. It's not in the 20s, maybe in the mid-teens, and it's passing through slowly. I think that's another important point. How much is the consumer bearing? And so far, we haven't seen as much as perhaps feared in Q1 and Q2. All of those, I think that rate coming lower, maybe settling in the mid-teens, as well as the transmission mechanism being lower than originally feared, are good for a Fed that wants to keep interest rates more moderate.
So that's the framework for thinking about this market. Let's talk about this market, how to express risk. So yesterday was an odd session. 398 decliners on the S&P 500, only 104 stocks advanced. This was very top-heavy, led by tech. Don't ask me why it doesn't add up to 500 on the S&P 500. Complain to someone else. This came from Deutsche Bank and Jim Reed, and he put up these numbers and said there were only 104 advances on the S&P, the fewest in over 2 weeks, and actually the fewest on an up day as far back as my data on advances and decliners goes, back to 1990. What's the takeaway from the last 24 hours?
I think the takeaway, maybe not just for the last 24 hours, I would say the last year, is that earnings growth is driving S&P performance, and you want to be where the earnings growth is. And where is that earnings growth? It is in those hyperscaler names. It is in AI, and frankly, it is broadening out a little bit to broad, large cap. And I think that's where you want to be. Could we get a few negative surprises over the course of the next 3 days? And could that maybe bring a little bit of volatility, some down days in the market? Absolutely. But is there a structural story here, especially around AI monetization? We think so. We've been talking about this from the start of the year with respect to our positive view around AI. And we think as long as we see that demand, as well as the monetization, as well as the user actually being able to benefit from AI, we might see that in ad revenues and such. I think this continues. I think it might broaden out to more of the larger cap names instead of just the 4 or 5 hyperscalers. I think that's something we're looking forward to and telling investors to focus on. But the point about yesterday and a very small percentage of the index being up is not a new story. It is a feature of this market, not a bug. That is where the earnings growth is.
So let's look at the BlackRock menu. You're familiar with it more than I am. Is this just a vanilla S&P 500 market cap weighted index story, express risk that way, or is there a more optimal way to express risk in this equity market?
It can be, depending on who the investor is. And again, some people just want, you're stepping into the market for the first time and you want something easy, and IVV will do the job for you. What we are telling investors, though, this is the time to focus on things like BAI, which is our actively managed AI ETF, which again gives you some of those very specific earnings story in the AI space. We think you should have that satellite allocation. The other thing that we're talking about is if you're thinking about the broadening out theme with respect to large caps, again, that is something you can do again with a BlackRock large cap value or a BlackRock large cap, it's called BLCR fund, which is sort of the rest of the market with a focus as well on a large cap tech. And then I think for many investors out there right now, especially, you're getting that 6.5, 7% 5% income. You no longer have to wait till you're 85 years old for fixed income. I own fixed income. I hope you guys do. Again, focusing on something like Bink, earning that 6% coupon. It's a really great opportunity, especially with the Fed poised to cut more.
Stay with us. More Bloomberg surveillance coming up after this. So here's the latest this morning. Nvidia extending gains after President Trump said he will discuss the chipmaker's Blackwell AI processors with the Chinese leader. Pierre Ferragu of New Street Research keeping a buy rating on the stock with a price target of $235. Pierre, that quote from the president overnight, and welcome to the program. Let me read it out for you. It's very basic, very simple. It's worth a few $100 billion apparently to this market cap. We'll be speaking about Blackwells. Pierre, how important is that we're opening the door to Nvidia being able to sell the high-end chips into China?
Well, John, think about it in absolute terms. Nvidia historically had like 20-25% of their revenues coming from China. So we are talking like a $50 billion annual revenue opportunity. So yes, as you say, easily worth a few $100 billion. Now, if you take a step back, the almost like the surprising perspective is that given the scale of the success of Nvidia, it's actually a relatively small moving part. When you compare that to what Jensen said yesterday in Washington, he said he was expecting like a $500 billion of cumulated revenue for the Blackwell and Rubin product cycles this year and next year. We are talking here numbers that are like 50% above what consensus expectations are today. So it's a very, very nice comment from the president on the duper super chips is actually a small moving part this morning compared to what Jensen said yesterday. Yesterday, Jensen said the market is still accelerating, which is very, very impressive.
He also said that China has made it clear they don't want Nvidia there right now, even though the president has allowed some licensing for some chips. If China can get their hands on Blackwell, will they then want Nvidia in their marketplace?
Yes, of course. What you see in the market is that, and we could talk about China this morning, we could talk about Microsoft, about OpenAI, about Amazon. Nobody wants Nvidia. Everybody is worried about like the market power they have, but nobody can afford not to use Nvidia if they can, because today being able to use Nvidia chips gives you a decisive advantage in terms of time to market. You can get stuff going immediately at the highest possible performance. But everybody in the long term is working on, alternatives to NVIDIA to keep NVIDIA's market power in check. And so you see OpenAI signing giant deals with AMD. You see everybody developing their own ASICs. And China is no different. They're developing their alternatives. But if tomorrow they can get a few Blackwells, they would take them immediately.
NVIDIA is clearly looking for an opportunity here, Pierre, and an opportunity that the president is offering them. But I just wonder to what extent China's been successful without access to the highest chips, the high-end chips. Pierre, it feels like DeepSeek was a moment that happened, we wrestled with it and just moved on. But from the people we speak to, Pierre, it looks like China's been hyper-focused on efficiency and the US is going in a different direction. Pierre, if you look at the strategies of either the US and China at the moment, who's got the lead? Even before discussing access to the highest-end NVIDIA chips, who's got the lead at the moment?
Well, the lead, it's a great question. The lead is definitely at the frontier. It's being first to market with the most advanced models. And on that front, there is absolutely no question the US is in a very strong leadership position. Then now, if you look at, so that's like the technological lead. So the technological lead is very clearly in the US. Now you have the industrial lead, you have like the efficiency lead. Players like DeepSeek are very good at making models more efficient, at distilling models, and so they play a very significant role. But when it comes to getting access to the largest clusters and running the most advanced models, all that is happening in the US for sure.
So clearly we're getting a move in the pre-market off the back of this story. Stock is up by close to 4%. Pierre, I need to talk about the earnings with you as well. So tech stories of today is going to be Microsoft, Meta and Alphabet. Tomorrow, Apple and Amazon. Pierre, looking across those names, any vulnerabilities for you and the team?
I think the street is still digesting what Jensen said yesterday in terms of the 2026 outlook in terms of AI infrastructure spending. So really what we're going to look at is all comments from hyperscalers. Do we see a confirmation of Jensen's forecast in the way they talk about their capex and their spending plans? And then in terms of vulnerabilities, no, very difficult to see that. We're definitely in a bull week where everything seems to be accelerating. And even when you look at Apple, who is not best position player in the AI race, they have a lot of tailwind at the moment. The iPhone cycle is actually playing relatively well for them, which has generated some very positive vibes and should turn into a strong earnings report.
Pierre, I remember waiting for Apple to cross that $1 trillion line in the sand. Can we just reflect on your career, Pierre? $5 trillion market caps. Pierre, how do you sort of internalize that number? Just how big that is?
Yeah, it's if you had asked me at the time, it's unbelievable. And the thing is that it's part of a broader, of course, of a broader phenomenon. And the number of multi-trillion dollar market caps that we have now in technology, it's mind blowing of growth and of also concentration of economic value in tech names. It's really mind blowing. And specifically on Apple, Apple is a very low growth, very legacy type of franchise now in the AI world. It's difficult for them to find the right grip on AI, but it remains a very, very high multiple expensive stock because the market is still valuing the quality of the franchise. So I think anything one on top of the other, yes, you end up at almost $5 trillion of market cap.
Just amazing. Stay with us. More Bloomberg surveillance coming up after this. President Trump planning to lower tariffs on China over the fentanyl crisis as China buys its first U.S. soybeans in months ahead of tomorrow's face-to-face meeting with President Xi. Let's stick with the U.S. and China. Mary Lovely of the Peterson Institute writing, systemic issues will not be addressed in this round. We're unlikely to see much progress. Mary joins us now for more. Mary, welcome to the program. Just first question, what do you regard as a systemic issue with regards to the U.S. and China?
Well, we see some of these systemic issues in Trump 1, treatment of U.S. intellectual property. But there's a whole host of issues having to do with what the U.S. perceives as bans or barriers that prevent U.S. exports into the country and contribute to the lopsided trade balance between the two. We have questions from businesses that American businesses operating in China in terms of export bans and other things that prevent them from having their own personnel in place. There's a whole variety of issues that have contributed to this tension, including older issues, which you'll remember from the first trade war, John. Things like industrial subsidies, China's support for firms through their state banking system, other things that make Chinese exports uber competitive in the West.
Mary, the president telling reporters that they're going to be speaking about Blackwell. This is one of the most advanced AI chips the United States has access to. Is the president, if he allows Beijing to buy these chips, is the president rewarding bad behavior?
Well, I guess it depends on how you look at it. I think there is a bigger issue here, which is how do we protect U.S. national security? And as you know, there is some contention within the Trump administration as to how best that can be done. There, of course, continue to be so-called China hawks who want the U.S. to do everything it can to prevent the most advanced technologies from falling into Chinese hands. There are others who believe that, and this has been said by the president, that one of the things we want to do is to get the Chinese addicted to U.S. chips, U.S. tech. So I think that we're seeing some difference in opinion. We always knew it was going to come down to President Trump's decision. President Trump is a deal maker. He would like to see an increase in U.S. commerce, U.S. sales to China. And of course, these chips are a primary way that can be done.
How much influence do you think someone like Jensen Huang has had on the president?
Well, I think the tech community in general has had an outsized influence on the president. not only through this, but in terms of his behavior toward crypto and crypto regulation and other issues. For example, in these trade deals that he's signing with other countries, we're seeing a promise by other countries that they won't levy digital service taxes and other kinds of taxes that might impede U.S. tech rollout to other countries. So in general, I think he's been a very tech-friendly president.
We have the contours of some sort of agreement that they're going to reach tomorrow. What comes next? Where does this leave the relationship for 2026?
Well, it reduces the tensions and potentially restores some market access to China. For example, by rolling back those fentanyl taxes by 10 percentage points, China will get down closer to 45% or even 40% average tariff rate, which means that the pressure on Chinese companies to go out, build their factories in other countries will be lessened. So we're going to see a significant decrease in tensions. Then I think there's a hope on the U.S. side that we can turn to issues which have prevented U.S. exporters from gaining more of the Chinese market. So I think probably or surely Secretary Bessent, Trade Representative Greer have a whole host of issues that they want to discuss with the Chinese, including, as I mentioned before, industrial subsidies, subsidies that come through the Chinese state banking system included.
Do you think China is willing and ready to make those changes?
I think China is willing to make some changes, not all that the U.S. wants. China right now is, of course, struggling a little bit to revive its local demand. It does not want to be as dependent on net exports. Net exports from China grew by 36% in the year to date. That means that a lot of Chinese growth is dependent on the rest of the world accepting their exports. And for many countries, that means accepting that they'll be permanently in a trade deficit position. So China knows that this reliance on net exports is really not sustainable, and they're looking for alternatives to that. So I think some of these changes are within the realm of things that Chinese authorities want to do. But when it comes to putting their development first, relying on growth in their tech industry, the diffusion of AI throughout their manufacturing, and continued emphasis on industrial development, those are not going to change.
Mary, you know about these issues far better than I, but this is a conversation that you and I could have had 10 years ago. And back then we were talking about Chinese overcapacity, and people said the same thing, that it wasn't sustainable, they needed to change, they understand that. And here we are 10 years later, and they're on course to run a record surplus this year, even without substantial trade with the United States. Mary, in your mind at the moment, in the history that you've been following this, what makes this unsustainable? What would stop them from doing what they've been doing for such a long time?
Well, they are really struggling. Obviously, they need to buy more of the things they make domestically, yet Chinese domestic demand has really been moribund. People don't have a good outlook for the future. Firms' investment outside of the tech sector has been, lackluster as well. So they really need to revive their own economy if they're going to, continue to have moderate growth, so about 5%, and not sell all those products to the rest of the world. I think not only the U.S. trade barriers, but trade protection that's being imposed by other countries, including in more friendly areas like the Southeast Asia, who are beginning to see a flood of Chinese imports that are hurting their own domestic producers. I think this response does have the attention of the Chinese authorities. The question is just now, how can they revive domestic demand? I'm just back from Shanghai, John, and I think that this was a major topic of discussion. They're talking about new things. Obviously, investment in the real estate sector is out. They have a lot of infrastructure. They don't need more bridges and roads. They're talking about things like social infrastructure, helping local governments to build things that will help people's lives, including restoring old buildings that need refurbishing, things that will help with children and the elderly, the healthcare sector. These are areas where they're starting to look, and we hope we will see some action by the Chinese authorities to do some kind of fiscal stimulus in this area.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.